it gives a sense of, as the economy opens up, how your bank does benefit.
Well, look, we are seeing, as the economy opens up, people spending again, businesses getting going. Well, we think we're in for a very good recovery in 2022. We've had a very good business 6 months as the biggest business bank in Australia. We've had very good growth, probably the fastest growth we've seen in our balance sheet since 2007, 30 billion increase in assets on the book in the last 6 months. So you're getting a sense of the Australian economy is bouncing back well, and we're doing particularly well in it.
You mentioned some uncertainties in your outlook, Ross. Can you highlight a little bit more of your main concerns for the year ahead?
Well, the uncertainties are, we've had two of our biggest cities being Melbourne and Sydney in lockdown, and as you talked, Melbourne was the most locked-down city in the world. We're now starting to open up, but it's what's been the impact on those small, medium-sized businesses that have been in the city and still not open yet. Where do they go? The general economy, though, there's been absolute winners out of it. And, you're seeing an economic recovery coming through. GDP was down in the last quarter, but we're expecting it now. We're open to be very strong and 4+% over the next 12 months. So looking bright for Australia. And it's across the board. Most industries are getting going again. We're getting really good growth across the board. Our agricultural sector's working really well. Manufacturing is doing okay. The areas that have been hit have been the ones that have been impacted by borders closed. Tourism, some of the education sector, because we've been a big importer of students for secondary education. We need to get those industries going again.
Ross, David here. Just a sense then, since you talked about how many sectors are improving, what's your outlook here on the housing sector, which has been red hot, really?
Look, you're right. The housing sector has been red hot. It's been 20+% growth in housing across the Australian market, and in New Zealand we were also very large. It's been 25. I think they're the second largest growth in any economy in the world. I think Turkey was the largest I saw, and then New Zealand. But look, what we need is stock to come on the market for the spring sales, and more stock. Interest rates in New Zealand have started to climb up, and fixed rates in Australia have started to climb up as well. So, the regulators are taking action. But we don't expect that growth to continue into next year. We see housing prices probably moving by about 5% in 2022. Still a good growth level, but not at the extreme that it's been going at for this last 12 months.
And yeah, I mean, the bond market volatility has been crazy, to say the least, in the last week or so, Ross. I'm just wondering, when it comes to your fixed mortgage rates, then I know you did have to hike them before the RBA meeting last week, but now that they actually have dropped this yield curve target, are we likely to see rates go higher?
You're starting to see fixed rates already moving. They bottomed out at about, for a 2 or 3 year rates, well under 2%. They've come up by 50 to 70 basis points over the last couple of months. Most banks have moved. But interestingly enough, variable rates, the basic variable rate has actually dropped. So you are seeing long-dated bond markets influencing the price of home mortgages, as you'd expect. But a very competitive market here. All banks play in it, small banks, digital banks. It's a very competitive market. What we've also seen, though, is in our business market, very strong growth. We are the biggest business bank in Australia. We've grown our market share in the last 12 months. And as the economy emerges, we expect to see good growth in that market without the contraction in net interest margin we've seen in the housing market.
Ross, when do you see the first big interest rate hikes coming in, and what sort of levels are you looking at? And how is that going to affect the way that you make money as well? Because this has got to be good for business if we do have a steepening yield curve there for you.
Well, that's been some time since we've seen interest rates go up through the Reserve Bank. The Reserve Bank here has been quite adamant. We're unlikely to see their rates going up till the end of 23, 24. They're very interested in unemployment down and wage growth showing through strongly before they move interest rates. We are starting to see wage growth emerging in the marketplace like every other country. we've had supply chain issues and shortages, but we're just starting to see wage growth coming through in a more regular sense as opposed to in certain sectors. So the Reserve Bank here definitely wants to see wage growth before they move interest rates, and they're still talking about late 23, 24. But interest rates aren't only dictated by the Reserve Bank. As we all know, there are other inputs, and those inputs are increasing. Bond markets are increasing, therefore certain rates, our cost of funding increases. We still have 20 to 30% of our funding from offshore. As those cost of those funds go up, it does impact through into the price of money in Australia and in New Zealand. But no signs from the Reserve Bank, and they've been quite staunch on it to date.
It looks like, based on what you're saying, Ross, your margins are probably about to get squeezed in the next few quarters. How much do you think your cost of funding is going to go up these next 2 or 3 quarters?
Yeah, look, our NIM is getting a bit squeezed. Probably we've had a lesser impact on our bank than a couple of the other majors, mainly because we've got a very strong business bank, and that's the heart of our bank, and a slightly smaller mortgage book than some of the others. But you've certainly seen our ability to reprice deposits down become very limited. So there has been a contraction. For our last year, there was about 5 basis points contraction, but most of that was to do with our funding and our markets business. On the core bank, it stayed flat for the last 6 months, but the pressure is on. To what extent? I don't know, but we've got limited ability to actually pull deposit rates down to actually complement the increase in pressure on our margin. So contraction will happen, but probably not as much as people think.
Ross, I want to talk to you about the city retail assets that you bought earlier this year. How are you feeling about that? Do you have any indications yet from the ACCC? And when do you start to make that transition work?
Look, we're still in the process of the ACCC approval and the regulator approval. We don't expect to get that till later this year and possibly early next year. We do hope that the transaction goes through because it does help our unsecured business, our credit card, personal loan business. Buy now, pay later is a very big item in the Australian marketplace. City has some assets in that area. So it's a good supplementary product set for us. It will double our business and give us good scale in the marketplace. It also brings white label capability that we don't have in the unsecured market. And there's some very large players that facilitate through City that we would look forward to working with and help grow their business as well. So it's attractive in our personal bank and does make us one of the larger players here in this marketplace. It gives us scale, which then means we can invest more, which is important, as you should understand, in that part of the market.
Ross, you plan to cut fossil fuel financing as a noble thing to do, and I want to know if you have a net carbon zero target and whether just cutting fossil fuel financing is enough. And on top of that, of course, we've got one of the biggest industries, mining, there in Australia. Now, are you going to cut financing to that as well? Because that'd be like cutting a nose to spite your face, surely.
No, well, look, it's interesting. We have led out today as the first large bank in the Australian marketplace to put our position on oil and gas. And we've said we're going to cap our lending into that market between now and 2026. And then in line with the IEA net zero emissions 2050 scenario, we'll reduce it after 2026. So, we've looked at the science. We believe it's the right measures to put in place. We haven't said we're out of it, but we are capping our exposure to the oil and gas market. We'd already made announcements about 2 years ago on coal. But interesting, we are the largest provider of funding into the renewable sector. 71% of all our energy assets are actually in renewables. So as a bank, we've been the largest player in the Australian marketplace for quite some time. And, we think we're in the right position. So, but look, it's not just oil and gas that we all need to be thinking about this climate issue. We all need to be playing our part in it. Australia has been hit with some horrific bushfires, storms, tornadoes, and all sorts that are just getting worse here in Australia, and we all need to take this absolutely seriously, and we're going to play our part. But this is just the start. We need to look across
Ross,
the largest agri Yes.
Ross, very quickly, do you have a net zero target? Many other banks in what year by?
No, we've signed up for the net zero. We've got our targets out there for the 2050 and very much aligned. We're one of the first banks in Australia to go out there in that position.
Ross, I'm wondering, it's interesting. You said you're going to reduce lending to the oil and gas sector from 2026. But then if you take a look at your loan book right now, you actually have room to grow in that sector by about 300 million Aussie dollars. Why not then, I should say, are you capping at where levels are right now?
Yeah, good question. We've capped over a 3-year average, because you must admit the last 2 years under COVID haven't been average. And also, it's all done in denominated in US dollars, when the foreign exchange has changed quite dramatically over that period of time. So we've capped it at $2.4 billion US dollars for between now and 2026 as the average of those 3 years of our business. And we have to work with businesses to transition. We all have to transition, and that's what we're going to help businesses do, and that's we're working with 100 top emitters on that very strongly at the moment.
And as a final question to that, inevitably, Ross, do you see return on equity, not just from your bank, maybe the banking sector, is that going to take some sort of hit as you move away from growth that is on the table that you might not just get?
We don't see it. We see some major opportunities as all businesses pivot towards a more climate-interested marketplace. We see there's some real opportunities. As I said, we're the largest funder of renewables in this marketplace. I think there's some considerable investment opportunities coming out across all sectors of the business because of the changes being made. We need to fund it. We are a bank. We need to fund these businesses to make the transition, and that's something we're signaling very strongly today.